Yeah, it is hard out there for a variable player. It's tricky, but hopefully they'll come back around. Though I'm feeling it's not going to be Q1 of next year. I'm now thinking Q2, Q3 before.
You heard it here first, folks. I'm thinking not next year at all.
The rates won't come down at all next year?
No. I think they'll level off.
Where are they going to level off?
Well, sorry. I'm not going to say not at all, but they might come down a little bit. But I think you'll see like, oh, we dropped by 15 basis points. And I'm like, sweet, I'm still getting absolutely dusted by my 7% rate right now.
Right.
I think it'll be the following year. I think next year's going to be a year of just like people
Batten down the hatches.
The start of the year is going to be people starting to fall off. I think like the idea that we have in our heads is correct, but I think the timeline is too quick. This is like when I started seeing things go wrong about a year and a half ago. I was like, 6 months, this whole thing's going to boil over. But yeah. I'm underestimating the amount of time that it takes for the rates to actually impact people, the cash reserves that every business and person carries, and then how long. Like what's each domino's like things start falling over.
I think you overestimated people's willingness to sacrifice and be frugal because people are still spending. People are not stopping spending, and unemployment is still super low. So these things that normally happen, people stop spending and people get laid off or whatever, aren't happening yet. And they keep cranking and being like, surely people will get the point now. And surely the economy will slow down now. And it's not. But the bigger underlying problem in there is that there's nothing they can do interest rate wise to slow down the cost of food because it's very expensive food production right now. They're keeping oil prices down artificially or not, we don't quite know, but oil prices are suspiciously low, and I think those are going to go back up, and there's no real interest rate that's going to be able to keep those down, especially with everything going on in Russia. And, in China, the production arm, like the supply side of things, it's just so expensive, and that is somewhat immune to monetary policy because monetary policy focuses on the demand side, not the supply side, and demand isn't coming down nearly as much as it should be, and we can't do anything about supply. Supply's
demand's going to fall off a cliff. When it does happen, it's going to fall off a cliff. This is the worst part about this. If things had started to ease off when I was kind of thinking originally,
but if it falls off a cliff, then that would be good. I hate to say it, but like that's kind of what's they're supposed. That's
Chandler's evil. If no one's gathered yet, this guy wants super high interest rates, and he wants it to fall off a cliff.
You cannot have both things. You can't have no inflation and everyone living a happy-go-lucky,
I'm totally in agreement with that.
Wealthy life.
But here's my one thing I was going to say. You said unemployment's super low. Now that you said it, I was going to wait till later. But unemployment's rising. Now, it's a 1 month. Yep. It's starting, and I want to see at least 2 to 3 months of that growth to be affirmative, because if you look at the unemployment charts, it does kind of...
It's also lagging indicators, right? Like, there's something called like wage stickiness, where it takes a long time for wages to come down because people have contracts that they've signed and agreed to, or that they've negotiated. They're part of a union. All these things can't come down overnight. They take a long time. Collective bargaining and all these things are there to protect workers in times of strife and economic downturn.
Yeah,
so it takes a while.
And this is kind of my thing, and this is what I was suggesting when I said I underestimated how long it takes things to turn over, because when you think about it, like there's still, like, I had a client over yesterday who's got a mortgage locked in at 1.74%, and he's not going to be opening that up for another year and a half. So it's like he's going to be fine for another year and a half. These, like the job contracts, like you just said, there's a lot of things that are already in place that are going to take a while to expire. Cash reserves that people already carry, the cash reserves that businesses made a bunch of money during this time. There's also all the cash that was handed out to a bunch of people. So a bunch of people banked that money. A bunch of people
sold houses. And
a bunch of people made a bunch of money on their real estate. Real estate was a great way to generate wealth. People made money on their cars. Like, it's like, okay, for the last 60 years, you've lost money on your car year over year, but almost everybody was able to buy in and out of a car in the last 3 years and not spend nearly what they expected. Or they traded in their leasing or cash back. But I want to say is in Nova Scotia, for the first time now in a while, well, not first time because we've had it a bunch of times, but in the most recent times, we're seeing unemployment tick up from 5.9 to 7.6%, which is a fairly large bump.
Wow, that's a huge bump.
That is a huge bump. That's 25%. Over the 1 month period. But again, it's hard because the numbers fluctuate like this based on immigration and what's going on. So I'd want to see at least 2, if not 3 months of consistent growth on that number, or it staying above the 5.9. So if it's 7.6 this month and then like 7 next month and then 7.5 again, that's just showing in general that it is trending upwards. But it's just scary to hear it when I saw that, because in my head, this whole thing that's been keeping me like, oh yeah, things are going great, is that people are like, well, our strong employment's going to keep us getting us through this. And I'm like, keep getting us through this. Sorry. And I'm like, okay, sweet. And now that I saw the headlines being like unemployment's going up, I'm like, oh, that's not
Yeah.
going to get us through this. And like the cost of stuff is super, super high. Like it's got to give. Anyways, I didn't want to get into that right off the hop, but you mentioned that stuff, and so I'm nervous, and so maybe I'll get into the first thing that I was talking about, and this is regarding housing. Like I think the worst is to come. Like so, I think the shell shock that we've seen so far. And tell me if you think I'm right or wrong, but like the first 10 to 15% that everyone's seen, I think some of the more hot markets have seen up to 20-25% is more sentiment than actual change in the market. Like it's more just people being like, oh shit,
Consumer
I saw the
confidence.
news. It's consumer confidence is dying, but people haven't really faced it yet. And that's because their pre-approvals haven't run up yet. Like there's still people that are coming out. Like I had an investor last week who's like, I got to get this thing sorted out in the next, whatever it is, 40 days because I have a pre-approval that's locked in until the end of that.
Yeah.
And I want to close on this bad boy at this rate. And they're still in the four ranges, which really aren't that bad. And so banks are projecting that in the next 3 to 6 months, you're really going to see things fall off because then people are going to be starting to get hit with a stress test at these new higher rates, and the spending power is not going to be there. On top of again, what's going on with the unemployment and inflationary costs elsewhere.
Well, also like
stuff across the
seasonal,
board.
right? Like everyone knows that in the fall and the winter, the housing market slows down, right? So there's also going to be these things. It'll be interesting to see what the seasonal adjustment is on these numbers because the actual volume of sales is historically dropped off a cliff already.
Yeah.
And that has actually helped to protect some of the real estate prices because sellers are just deciding, okay, if the buyers aren't confident, I'm not confident either. So sellers just aren't putting their homes on the market.
What if people get forced though?
Well, like to your point, that's going to take a while for them to get forced. And we've covered this before. 1 in 3 homeowners has no mortgage at all. The remaining 50%, over half of them are on fixed products. So you're talking about maybe 1/3 of real estate owners out there who are on variable products, and it's hard to know what their resiliency is going to be, how long they'll be able to hold out. Because what's their alternative? To sell it, potentially lose money, and then rent an apartment for more than it costs for them to live in the house. Like it's not like there are many viable opportunities, and the mortgage payment is the last thing that causes someone to go bankrupt. Like there's all kinds of other worse debt that people sacrifice first. The first payment you make is and should be to your mortgage. It's those others, the Visa debt, the line of credits that's unsecured, the Home Depot, the Best Buy card, all those other things that start crushing you, and were the sort of things that people racked up when money was no object. Those have a way higher interest rate. So I don't know that it'll necessarily be the mortgages that put people.
But the mortgage is the biggest one. Like your Home Depot line of credit, your unsecured line.
Oh,
of credit,
absolutely.
Your car payments are not even half of what your mortgage.
It's the biggest. It's the biggest one for sure. But it is the lower interest one, and it's the one that people prioritize. So they will kick a lot of things down the road before that one hits them. But what you're talking about is if the unemployment spikes, well, now it's like a double whammy. It's one thing to have the high payment when you're employed. If the unemployment goes up significantly, so then it's a question of, well, of those 1/3 of homeowners who are on a variable product, if it's even that high, it's maybe a little bit lower. How many of them might also suffer job loss, right?
That's what I mean. There's gonna be job loss, and cuts because, big companies like a bunch of people I'm sure listening saw last week that Ford and FedEx announced that they're gonna miss their earnings targets or profits targets by a ton. Like Ford was projected to make $3 billion in the last quarter. They're saying they're probably gonna make about 1.7. That's enormous. Like that's almost a half cut on your profits. And what's going to happen from that? They're saying they're getting gouged by suppliers, but I think they're dancing on the fact that they're having way less demand. And it's because people don't want to buy right now because car financing is $599, $799.
But the margins must have come down on some of those vehicles too.
But it's both of that. Like I think the inflationary pressure from all the suppliers is a thing, but it's also there's gonna be less purchasing going on, and so
is
they're
it
going to
also
start
because
laying
they're
people
Ford?
off. No comment. No comment. But I am a GM person. But so there's that. Is like those people, like even good paying jobs in the secure jobs, people are like, well, I work at Ford, like I will never get laid off because it's a massive company.
Yeah,
they're going to start seeing those happen.
When I was broke, I had rich habits. When I was broke, I had rich habits.